I'll look at a percentage notion in a minute. For capital projects, there's a notion of an internal rate of return, IRR. Now, IRR is analogous to yields to maturity for a bond. You understand? Internal rate of return is a percentage. Could I pick projects, capital projects, based on internal rate of return? A project that gives me a high percentage, but not so much value? That's not going to work either, is it? It has to come back down to one numeraire, and that's a wealth measure of currency, euro or rubles for you. That's all it's going to work. So this technique, I'll contrast it some more, cannot be the way to pick capital projects. It's got to be a wealth-based measure. Let's see what the meaning of this net present value is. That's what I'm interested in for right now. I'd like to go back to my little cash flow pipeline. I'd like to know what is the meaning of net present value. Right now we can compute it, but we need to think in simple terms what net present value really means. So that when you go to work for your company in a year and a half or 2 years, and you walk into the company one day and they say, well, we use payback period, you have to have an argument as to why you'd like to change the way, encourage them to enhance or improve the way they pick capital projects. And you need to explain it in words, not just a numerical example. Excel eats up numerical examples. It can't explain the words, but we can. To do that, let's do an amortization schedule. Amortization schedule. And what it's going to show us is the meaning of this thing called net present value. That's what I'm most interested in. Notice a couple things. My cash flow pipeline. These after-tax cash flows here in my project, which we'll compute in a little while, are these after-tax cash flows here. How are they distributed and who are they distributed to? Bondholders get paid first. They're promised payments. That's what the word, remember, bond meant, an agreement between two parties. The slang term in the United States is, my word is my bond. If I say I do something, I will do something. That's the origin of the name of the security, bonds. And the next people we get some cash flow, as my cash flow moves down this pipeline, some goes to bondholders. On down the pipeline, some goes to other bondholders. I may have as we talked about, the senior bonds, they get paid first. Junior bonds, your little brother is paid second. And on down the line, I pay my preferred stockholders. Remember when we studied preferred stock? What's the word preferred mean? They get paid first. They got first claim on the cash flow. They have to get paid first, they're paid second, they're paid third. And who's left over? Who's left over is the common stockholders, the residual owners of the company. Whatever it is. If it's a bad year, maybe they may not get anything. If it's a good year, they get the whole pot, or whatever's left over in total. That's what net present value means in a nutshell. Net present value means, stated in today's terms, present, valued in a currency, value. See, that's why that word value is there. That's the tie. This is a specific tie back to my goal of the firm we talked about the very first day. Come full circle. And net means that I recognize I've got to spend some money to get some money. Net, it's the difference in the two. I defined it over here. The net present value, it's minus the initial outlay. We'll talk for a while how to estimate that number, plus the present value of the cash flows. Hence the word. I like words. Net, it's a difference. Present, in today's terms. Value, in terms of matching it back to my goal of the firm, which captures all three elements of what? Cash flow, timing, and risk. What's the probability of this being on the final exam? Question number 1, 100%. Goal of the firm, 100%. You're going to see what again. This is the most important thing of all. It's kind of, we know what we're about. It's like you're coming to talk, to be advised about what career path you want. What's the first question your advisor asks you? What do you want to do? And if you can tell me what you want to do and I'm your advisor, I can tell you what path to take, what courses to take, and what direction, and how to get to where you want to be with your goals. This started off our class as we end up today. That has to be the very first thing of the very first day. What do you want to do? And then everything else falls into place again. This tells me which of these two is the best. Must be this. This tells me how to value bonds, or shares of common stock, or preferred stock, or any of the securities we've looked at. This saves us. If we had an IBE t-shirt with a symbol on the front, stencil on the back, value is a function of cash flow, timing, and risk. They'll tie everything together with me. We should have those. Amortization schedule. This will help us out too. Let's figure out what this means. We characterize, this is called a finance class. Finance class means that I'm going to borrow $10,000 from some place at some cost, and I'm going to generate some cash flows, pay them all back, and have whatever's left over. So this net present value really measures this. And I'll show that with the schedule we've done several times with amortization. Remember the word? Latin is mort. Amort means dead. It means I want to pay that loan down to zero and have some whatever's left over. We say in my home state that's the extra. There's no such word as extra, but it's the excess. It's the net. And to do that, I've got a schedule that looks like this. I'm going to start off with a beginning amount. Beginning amount. Let's see now. I'm going to have some a balance like we've done before with interest. And my interest is going to be, my borrowings are simple, 10%. We talked about where that comes from, 10%. Beginning, balance with interest. Payments to the bank, and a remaining balance. We've done this. The beginning amount's $10,000. Those are my borrowings. Note in my table, it's a wealth-based table. Rubles, dollars, Swiss francs, euro, many possibilities. 1 year goes by, and I owe the bank $11,000. I'm going to dedicate those cash flows to pay off a loan, $3,500. I make a payment. My remaining balance is $7,500. I then owe the bank $7,500. They add on my interest. It goes to $8,250. I make a payment of $3,500. I'll do the rest of it. I owe the bank $47.50. Beginning amount $47.50. At this stage of the game, it doesn't look like it's going to work out, does it? It's not going to be enough. I add interest of $52.25. My balance is, I pay $3,500. My balance is $17.25. I owe $17.25 to the bank. They add on interest of $18.97. My last payment $3,500. And what happens? I have minus $16.02. What's going on? What's happened? I have more than enough cash flow to pay off the money I borrowed at the bank. An excess. If I can pay more than pay off the loan at the bank, who does that excess amount of money belong to? Whose is it? What if I took that 1602, and took it back to time zero? Found its present value.